If we look at India's growth rate over the past 10 years, it was closer to 6.1%. And COVID notwithstanding, I mean, 6.1% was still very good in the global context. But yes, it's not that aspirational 8 to 10% that we want or that we think we are entitled to.
To put your finger on one number and say, this is my potential growth forever, is very difficult. Because as the structural transformations happen, the potential growth itself moves.
For us as Indians, I think the main question is how fast do we need to grow in order to create the jobs that we need to create?
The subject is, as you have seen, that taking India to a higher growth trajectory amid global headwinds. We're not talking about Trump and all, but you know, underlying meaning is what's happening there. So we will brainstorm in the next 40 minutes or 35 minutes. What do they say? They represent, I'm not again repeating them. Who are they? We know already discussed and all. So next 35 minutes we'll discuss that. We'll take a few questions also. First thing, Aditi, you will say again the same thing. Alphabetically, you come first. A. You know, suddenly we have found that the new RBI governor has coined a term called aspirational growth. Till now, RBI terminology never spoke about aspirational growth. We know about real growth, we know about nominal growth, but now aspirational growth. So as an economist, and all three of you, can you just tell us what is this aspirational growth?
Sure. Thank you so much, and thank you for inviting me back to this panel. So I think aspirational growth needs to be seen in the context of potential GDP growth. So perhaps, the context is that maybe 10 years back, we used to hope that India's potential GDP growth will be closer to 8 to 10%, maybe 8% for people like me, 10% for some others. And now, across the board, potential GDP growth seems to be being pegged closer to 6.5 to 7%. So that's fine. But we still aspire to be an economy that has an 8 to 10% growth rate. I think that is the context in which we should see that comment. And what I feel is that when we did think that growth would be 8 to 10%, potential GDP growth would be 8 to 10%, that didn't really turn out to be the case. So if we look at India's growth rate over the past 10 years, it was closer to 6.1%. And COVID notwithstanding, I mean, 6.1% was still very good in the global context. But yes, it's not that aspirational 8 to 10% that we want or that we think we are entitled to.
Samiran, 10%, 12% aspirational growth.
So first, thank you, Business Standard, for giving me this opportunity to come back here again. And thank you, everyone, for surviving a grueling, now 9 hours, more than 9 hours, 10 hours, and still listening to us. On a lighter note, let me say that both as a student of economics as well as someone who has taught economics for 6 years, never in an economics class we have been told of this terminology of aspirational growth. We have always been told potential growth, and Aditi has been very smart in combining the two and saying that potential is equal to aspirational. But if I'm slightly more serious on this, the issue really is that the traditional way in which economists typically measure potential growth, we are facing two problems here. One problem is that if you look at past data to calculate potential growth, then COVID has created a massive disruption in that past data to calculate potential growth easily. And the second problem is that in emerging market countries like India, which is undergoing rapid structural transformation, to put your finger on one number and say, this is my potential growth forever, is very difficult. Because as the structural transformations happen, the potential growth itself moves. And that's where I think the policymakers are now keeping this sort of intangible number in front of us called aspirational growth, which you can keep that number to be fixed for a reasonably longer period of time without being bothered about the structural transformation part of it.
Thanks, Samiran. I thought because of your global norms, etc., you'll be very diplomatic, but you're very frank. Okay? Sonal, I gave you time because all the way from Singapore, you're too tired, and she's going back also. So not from Delhi, not from any other part, all the way from Singapore and returning tonight. So you have got your time now. React.
Yeah, no, thanks a lot, Tamal. I think, for us as Indians, I think the main question is how fast do we need to grow in order to create the jobs that we need to create? And if India needs to create, let's say 8 million jobs annually in the non-agriculture sector, what is that growth we need to aspire towards to get that job getting created? So I think for me, aspirational growth is not so much about potential, which is looking at what the current capacity is to grow, but how fast we need to grow to create the jobs that we need to create. And I think the other good sort of framework to think about is how fast did some of the fast-growing economies, let's say in Asia, grow when they were going through their rapid growth phase. So for instance, the East Asian tigers, when they were going through, let's say, 1960s to 1990s during that period, or China's growth post the WTO accession, these countries were growing at 8 to 10% annually for more than a decade, almost for a couple of decades. So you need to grow that fast, sustained for a long period of time in order to create the jobs. And this is an important target for India. And I think the context of this panel discussion we are having, which is growing this fast when the global economy faces the various headwinds, brings into actually a few questions that we need to answer, which is, how can India gain more export market share when the world is turning more protectionist? And how can we, revive and boost domestic demand while ensuring macro stability so that we can grow that fast? And it's really the answers to these questions.
Yeah, Sonal, we'll get to that and all. So aspirational growth, potential growth, and all kind of stuff and all. But just, what is the post-COVID, what is the new normal for India growth story? Even before this tariff shock, etc., is coming, we are settling for 6.5% growth. That's what you will be talking about. So what is the ideal stuff? And also in this context, particularly after the last quarter growth numbers came up, there is a debate between nominal GDP growth versus real GDP growth. Even though we are pretty excited about real GDP, but nominal GDP growth was, as you know, pretty low. I'm not getting into all the nuances and the debate and all, but as an economist, what's the right indicator for us versus, like first run we were talking about aspirational versus potential, it's nominal versus real GDP growth. Aditi, you hang on, Samiran, because you are the most outspoken.
So, how to think about what is the normal growth rate? So, we economists love this way of presenting it in terms of consumption's contribution, investment contribution, and net exports contribution to growth.
We don't understand anything, just demystify.
Yes. I think
Simply.
These words, I think everyone in this room has heard: consumption, investment, and exports. Otherwise, you wouldn't have survived till 7 p.m. Now, historically, consumption has contributed about 400 basis points to GDP growth. Investment, if it grows at around 7%, it contributes another 200 basis points. So just consumption and investment, under very basic assumptions, can give you 6% GDP growth, which I call almost a recessionary threshold for India. If growth rate, real GDP growth rate falls below 6% in India, something is wrong. We feel like something is wrong. And then, if we are lucky, then investment grows a little more, not 7, but maybe 10 in certain years. If it grows at 10, you get another 100 basis points from there. And if you are even more lucky, then net exports contributes some 50, 100 basis points in an environment where external is a tailwind rather than a headwind, then you can potentially go at above 7, maybe closer to 8%. That's the way I would like to think of normally growth. And very quickly on your second part of the question, nominal versus real, look, we can't keep on changing our goalpost depending upon what suits our narrative. If for so many years we have been tracking real GDP growth and saying that should be the lodestar for policy making, suddenly because nominal GDP growth has fallen, we change it and say it's fitting our narrative better. Why I'm particularly making this point is that who knows next year, because of this extremely low base of inflation numbers might be 5% also. And that time, nominal GDP growth might be super high. Would we be saying this is overheated economy? Because nominal GDP growth has gone so much. So I'm a bit hesitant. I understand all that tax collection, credit growth, debt to GDP, everything is based on nominal GDP growth. I get it. But the fact is that as long as we are not calling this inflation period to be a structurally low inflation, if someone is willing to raise his hand and say that I'm convinced this is a structurally low inflation period, and that's why nominal GDP is low, then I'm willing to debate that. But if someone says, no, this is the kind of temporary transient phase of inflation being low, and that's why nominal GDP is low, we have to ignore that period.
Fair enough. So, Sonal, anything to add?
No, I think nominal GDP is equally important. Obviously, we don't need to change the goalpost. But nominal GDP at 8 to 9%, which is what we are going to get in FY26, has consequences in terms of the revenue that government collects. It has consequences on corporate revenues and therefore their decision making in terms of future cash flow and capex. This has implications also for how households react. So, in India, people have been used to seeing nominal salary growth of 10-15%. But when salary growth comes down to 5%, you can make all the arguments about, but inflation is low, so real salary is high. But how you behave as a consumer is on those nominal variables. So I think both nominal and real are important, and the divergence we are getting right now between nominal and real is sort of creating this disconnect and this debate about how resilient or not is the underlying growth, which is why you have people either painting it as glass half full or half empty. From a more medium-term perspective, there are quite a few structural changes happening, not just globally, but also in India. The fact that India is in an inflation targeting regime will have positive consequences on the structural inflation. We may be seeing cyclical undershoot on inflation right now, but the experience from other countries is that when countries embark into inflation targeting regime, it does lead to expectations coming down. It leads to better supply side responses from the government. And over time, inflation does come down. So, if you think about, 20 years back, we were growing nominal at 15-17%. Today, the steady state nominal growth is maybe closer to 10 to 10.5%. And therefore, how we think as a society, which is in nominal terms and not in real terms, will take time for the behavior and mindset to change, but these are important structural changes that are also going on right now.
Yeah, Aditi, you want to add anything?
So I think I'll just add that I do agree with bits of what both of you said, but in terms of targeting, I do think that real GDP growth is what we should keep our eye on. And one thing that I want to add on inflationary expectations. So typically for a household, when food inflation is very low in YOY terms because there's a base effect, I don't think that a household really internalizes that. They still seem to think that, in the winter vegetables cost this much and now they're more expensive in the summer. They don't care that, last summer because of some reason or the other inflation was much higher. But with the GST cut, I think this is very interesting that with the GST cut, when people are going to look at ticket prices which are coming down, this actually will get internalized by people. So hopefully, inflationary expectations will actually structurally come down a little bit, at least for the non-food items.
GST cut. Samiran, this question for you. Uh, in February, we saw in budget income tax cut. At that point of time, US tariff was not the story. And then pre-Diwali, we got the GST cut. And of course, we can see, if you look at the media immediately after that, how the two-wheeler sales, car sales, everything went up, kind of stuff and all. We saw that and all. But this GST cut and income tax rate cut is not RBI rate cut that every 6 months it can happen, rate going up, rate going down on liquidity and all. It's not one-off cases and all. So do you think whatever that happened is enough to sustain the growth, or more thing needs to be done?
So, as you know, tax policy is a cyclical tool and not a structural growth.
Exactly.
So, clearly the anticipation or expectation was that at that point of time that the economy is in a cyclical slowdown and needs a bit of a cyclical boost. That's why we did the income tax cut in February. And then the GST cut also happened. Now, while I understand completely the cyclical element of it, it is also true that if you look at income tax collection as a proportion of GDP, that was on a sustained uptrend before the income tax cut happened, which was sort of becoming a structural argument that households have to pay so much tax that they don't have enough money to spend on anything else. So that way, there was a need for these tax adjustments because if not anything, inflation has gone up. But tax rates don't get adjusted for inflation every time. Now comes the difficult question, which is how long will this last? So one way to look at it is, and Aditi was hinting at it, is that there's a price effect and there is an income effect. The price effect is that you are fence sitting whether to buy a television or not. You see television prices come down by 10%. You jump and buy that television. But once you have bought that television, you are not going to buy another television next month just because prices are there. So that new price then becomes internalized into your system. And the initial consumption pop, that fizzles out. Then comes the income effect, which is that on all the products that you consume in a month, how much are you going to save because of lower GST? If that number is substantial for a household, then out of that savings, you can spend something and you can save something. That will be a more longer term impact on consumption. And the most important part is that if all these things, they start creating a positive narrative in the economy, both in terms of demand increasing, leading to higher capex, higher job growth, higher income growth, or the positive sentiment leading to wealth effect in asset prices going up, then those things can further move this for a longer period of time. So yes, these are cyclical policy tools, likely to have more shorter term effect, but if they can rekindle a positive cycle, then it can last long.
We need to wait and watch. So, subject is taking India to a higher growth trajectory amid global headwinds. Sonal, you spoke about markets. So now, suppose the US tariff, etc., continues. So then, what's the choice before India? Looking for new markets, or we have been talking about this, consumption, local consumption, creating the local demand and all. And if you remember many years back when government was, doing that Make in India sort of movement, Raghuram Rajan, by the time I think he stepped down already RBI, as an RBI governor, he said that it's not Make in India, we should make it Make for India. Now we have gone back to that acceptance. Probably we need to go Make for India, which is mean local consumption. So is this the answer to US tariff or what?
I mean, I think all of the above. And we basically need an all-out strategy to target growth. Number one is sort of the conversations that are going on with the US to ensure that at least India's tariff rates are closer to the countries we are competing with. So most of Southeast Asia is at 19-20% tariffs. So at least on a relative basis, you know, if our tariffs are at similar levels, we are at least not at a disadvantage. That's one. Second, the diversification of exports to other markets. So all the free trade agreements that India is looking to sign with EU, you know, in countries in Asia or countries in Latin America is an important strategy. But one thing I would point out is that the entire world is looking to diversify and hedge from the US. So the competition that India is going to face outside the US markets is not going to be any less. And therefore, the things and the strategies that, you know, exporters need to do to compete and survive and get the market share in US, the same strategies will apply as we look to diversify. So the focus on having the right products and being competitive in certain niche products or producing, let's say, low-cost products but high quality. So those strategies will need to continue when we are diversifying. The second element to this is maybe the idea of indigenization and reversing the import substitution. This, to an extent, is tied to the strategy of building more resilient supply chains. What we are seeing right now from China in terms of, you know, export controls on rare earth increases the importance of, over time, it's going to take time, but increasing the ability to have, you know, our own mining, you know, processing on the critical minerals supply chain, more indigenization on defense production. So we can identify a list of sectors where we need to have more resilient supply chains. So that's going to be a second part of the strategy. And the third part of the strategy is what you said, Tamal, which is, you know, boosting domestic demand. And there are different pillars within this. We can look at the entire, you know, huge opportunity that is there in the food processing sector, for instance, in India, manufacturing linking to global value chains. India is still seeing a big increase in export market share in US on the smartphone side. A lot of countries outside the US, in Europe, Japan, Korea, are looking for destinations to put money in. So India still needs to focus on ease of doing business to get integrated into those markets. So I think it's going to be a combination of all those strategies. So reforms and focusing on things that basically increase competitiveness, good quality, some of those basic things don't change.
Aditi, for you, we have right now at least two regulators, both SEBI and Reserve Bank of India. There are a lot of regulatory reforms. RBI governor on record said that regulations are not come on the way. No, liberalizing. I'm not wasting our time to getting what all RBI has done. SEBI also, you know, it's a sweeping changes. I mean, what do you call it? A repetition as a kind of glasnost. That's what you are seeing and all. Now, do you think a similar kind of reforms we need to also have in other areas, judicial reforms, labor reforms, reforms on bureaucracy, so many other things. It's just the regulatory reforms is only the beginning. If we want to really push growth, we need reforms in other areas also. And if it is, then which are the other areas?
See, I think you're quite right. We do need reforms in other areas as well. But I think we need to also focus on one more aspect. When we're talking about taking India's growth to a higher trajectory by 2047, let's not just focus on the macro India concept.
We're not talking about 2047. That's not in the subject. It's just growth higher trajectory.
Higher growth.
Forget about the particular date.
So higher growth by whenever, maybe 2027. So it's not just, let's not just look at India as one India, but let's look at India as a combination of all its states. And I think at the state level, there are states which have grown very fast in some periods and not grown very fast in other periods. So maybe we also need to come back and look at what can make growth higher for each state. And the answer may be different and perhaps every state needs to introspect and see what can be done. We have a lot of changes coming up which are going to affect the center state fiscal picture, for instance. We have a finance commission report which is due in the next few months. We have a pay revision that is coming up. And I think, how much financing is left for different competing priorities. That is also going to have an impact on, what parts of the economy actually end up becoming drivers of growth going ahead. So for instance, if we have a fixed nominal anchor for the fiscal deficit at the state level, which is typically pegged at 3% of GSDP, the gross state domestic product, and a lot of states want to go ahead and implement more welfare schemes, then how are we going to protect capital expenditure? I think this is again something that is a question that needs to be answered in the next few months to be able to make sure that we don't lose that sight on capex at the center and the state level. And perhaps one way of ensuring and ring fencing capital expenditure at the state level is a continuation of the interest-free capex loan scheme that the government of India has so successfully implemented over the last few years.
Just a quick comment on the reforms part. Look, I have always believed that reforms is a continuum and not just an episodic one-time thing. Especially for a country at $3,000 per capita, we can't just sit back and relax and say that whatever reforms have to be done, we have done everything. So there will always be a requirement for reforms and we'll keep on doing it. At this point of time, I feel a particular type of change is required, which is that, as you rightly mentioned, that different regulators, different bodies are coming out with their own reforms. These are like beautiful flowers, each one of them. Someone needs to tie these flowers into a bouquet and present it as a narrative to investors, to businesses. That will change this sort of negative headline that is there that, oh, India is suffering from global headwinds, this and that. That narrative can be changed, especially because we have not caught up to the AI narrative. So we need an alternative narrative, and that alternative narrative could be the reforms narrative if it's presented in a form of a bouquet.
Samiran, in that narrative, do you think infrastructure can play a role? Because we have been talking about infrastructure, citing China and all, but nothing much happening in the infrastructure financing, I mean. We have created NAFED, of course there are numbers, but if you look at this, no, not much. So do you think that massive infrastructure investment actually can give a big push to the growth?
Again, I'm saying that the narrative is important. If you recall when this National Infrastructure Investment Plan came, it was grasped so quickly by markets, that 1 trillion number. We need NIIP 2 now. There's a need for the next 5 years infrastructure plan. So this at $3,000 per capita, we just can't say that whatever our infrastructure requirement is, that's already done. For many years, we are now at about 6% of GDP of infrastructure spend. We need to take it up to about 8 to 9% of GDP. So there's still a lot of room to grow.
Both Aditi and Sonal, both of you is, of late we are seeing that, again, a part of this a liberal approach by Reserve Bank of India, as well as the government. In financial sector, we are allowing foreign entities, FDI, having a bulk stake in banks, private banks. We are now considering also raising the FDI, foreign investors' stake in public sector banks. It's nothing confidential. DFS secretary gone on record and all. So, do you think along with that, this is also time to look at privatization in certain sectors? Again, to give a big push and creating a narrative?
Yes, I think.
And if it is yes, then what are the areas we should look into?
So I think the target is efficiency and productivity, and privatization is basically a vehicle to implement that. So it could be sectors, it could be consolidation of public sector banks, The increase in foreign stake, of course, will enable them to raise more capital, increase more competition, focus even more in those specific areas. It could be, for instance, in the energy space. There are a whole host of companies in metal and mining sector where there could be more privatization. So yes, privatization, but privatization is happening with the objective of not like raising money, but with the objective of increasing productivity and efficiency in those specific sectors. And I do think, India is in a good place in that there's just so much to do on infrastructure. To boost growth, because infrastructure spending both creates supply long-term and creates demand for different sectors in the short term. So given global capital is looking for long-term growth stories, if we can actually create a structure where a lot more of foreign financing on the infrastructure side can also come in, it can actually be a win-win solution for India and global investors.
Yeah, Aditi, no, you don't have to repeat the same thing, but you touched upon something about the state's fiscal health. So do you think that the entire growth challenge, where does the state fit in? Like we had our central fiscal deficit, we had a roadway and all, which of course we had to deviate because of COVID, etc. But do you think the time has come now, we should have, for the states also, there's a clear-cut road path about capping the fiscal deficit, to what extent they can go? Quickly, where we have about 4 minutes, and then we have a couple of questions left, and then, yeah, tell me.
Sure. So, for the states, their fiscal deficit is typically capped by the amount that they are allowed to borrow.
Correct.
And their borrowing is controlled by the government of India. So you cannot deviate too much on the fiscal deficit itself. And as a group, in most years, the states have been below 3% of GDP as far as their collective fiscal deficits are concerned, particularly because a few large states tend to underspend on capex relative to the golden rule of 3% of GSDP,
Yes.
and that pulls down the overall number. The problem at the state level is that their debt to GDP ratio is hugely variable. So we have some states where the debt to GDP can be 15% or below, and other states which can be 40% and above. So the path that we need is a realistic path to bring the highly indebted states to a lower debt to GDP ratio. And debt is a very narrow concept when we talk about states. Some of them give massive guarantees, so we need to think about that as well. And of course, now we have the off-budget debt, which the center has tried to bring on budget by making it part of the borrowing ceiling. So ideally, we need to look at all three: debt plus guarantees plus off-budget, D plus G plus O as we call it, and have some sort of a state-wise trajectory to bring it down to a more manageable level.
I wish Somakati Ghosh was here. You are supposed to join. We could have asked him because he was a part of the Finance Commission. Report is getting ready. Unfortunately, he couldn't attend. We have about 2.5 minutes left. I have a couple of quick questions, but before that, any question from the audience, from anybody? Yeah, this gentleman, please. Quick, just introduce yourself, no comment, have just question. After that, we'll have a quick one round. Yeah.
Hello, my name is Shirish Bapna. So my question is, traditionally, why have Indian brands struggled to go global? I mean, what are the major challenges and how do you see it panning out in the, let's say, next decade?
Thank you. Anybody else? Indian brand going? Yeah. Quick answer.
Quality
Thank you.
and cost. So, low cost, high quality, and so, that combination needs to be there. So, I mean, there are certain brands like in textiles, towels, for instance, there are certain brands who have actually done well, but I think that combination and scale, so maybe third I would add is scale. So, quality, cost, scale, if we map those three metrics, then we can do well. Now, going forward, in terms of prospects, I think so despite the US tariff on India, I think the quantum of manufacturing in China in a lot of sectors, things like toys, textiles, is tremendous, and that is looking to alternate destinations. Vietnam and some of those smaller countries cannot take up all the supply chains that are moving in. So India will play a big role in things like textiles, toy manufacturing, leather garments, electronics, the entire supply chain on the electronic side, for instance. So I do think that India's export market share across a number of product categories is going to go up, but it's important for us to focus on quality and our cost. I think quality focus needs to be like the #1 priority for India.
Thanks, Sonal.
Yeah.
We have 30 seconds, but I have just two questions, but one word answer from each of you, so we'll stick to the time. Promise. So one is this: what is your best guess? We'll start from Aditi. Best guess, what would be like India's growth in the next 5 years, average growth? Two scenarios: if US tariff revert back to 15 to 20% range, or get stuck to 25 to 50% range. What would be the best case scenario? Next 5 years, India's growth story.
So 6.5, veering towards 7% if tariffs come back down to a more reasonable level, and 6% or thereabouts if they don't.
Sonal?
Yeah, no, I agree. I think 6.5 to 7%.
Don't agree, just disagree. Just say something.
No, 6.5 to 7%, and I think exporters will find a way.
6.5 to 7% in which scenario?
Both scenarios, because I think exporters will find a way to diversify, and I don't think US tariffs are going to be a permanent damage.
Okay, so there is no difference whether US tariff comes down or not.
The
same
range
growth.
gives enough flexibility.
Samiran?
Yes.
Are you asking aspirational, potential, real, nominal?
Your take.
Huh?
Your take. What's your idea? Not aspiration. Certainly not aspirational. Potential in two scenarios. Like Sonal said, irrespective of the scenario, this is the growth.
Yeah, because your two scenarios over a 5-year horizon are
Yes.
definitely not going to play out.
Okay, just
Like the more than 25% tariff for 5 years is just an impossible scenario to imagine.
Okay.
So I'll stick to the first scenario and I will say it's possible for India to grow at 7%.
Okay. Last question. Today is what? We are October end. It's about 5 weeks down the line, Reserve Bank of India's next policy, right? And RBI, MPC note, everything talks about there is space for rate cut, etc., etc. CRR cut has already taken place, but bankers, many of them are there. They say despite that, there is a liquidity is an issue. Will RBI do OMO and all? I'm not getting into all the technicalities, but you guys and all of you, you have the privilege of meeting governor and discussing things ahead of the policy. What do you expect or recommendation in December? Are you going to say rate cut or no rate cut status quo? Not you, Samiran. You started the thing, so you will end from here.
So, we thought that there is space for rate cut both in August and October policy from an inflation standpoint. In December, the rate cut is not about the space, it is about the need for a rate cut. So we'll have to observe that whether between now and December, there is any discernible sign of any growth slowdown or not. And that's why I'm hiding behind wait and watch.
Sonal?
Central banks should be forward-looking rather than data dependent all the time. And I think the forward-looking outlook on growth inflation provides the space. So, I think they should move.
Rate cut. Move meaning cut. Move down. Aditya.
So the last round of reduction in the inflation projections for the current year and for the first half of next year has come in because of GST, which is a policy change lowering the prices. That is not indicative of a demand slowdown, but it is going to bring with it better demand. So in this case, I'm quite torn. I think a rate cut could have happened earlier, but as we go closer toward FY27, I think it's going to be more and more difficult to cut rates. So I am really on the fence for December.
Despite so low inflation.
Yes, because the latest round of the reduction in inflation is coming in from the GST cut, which is going to bring with it better demand.
Okay, thank you. Time is up, and I'm not going to take more time to summarizing this. I hope you enjoyed. We tried the last show. We tried to make it interesting and exciting. I don't know if you like it. Just give them a big hand. Thank you all. Thank you all.